Today, we're diving into a crucial topic that every investor needs to understand: inflation and how it impacts your investments. You've probably heard the term inflation thrown around in the news, but do you know how it directly affects your money, your financial goals, and the long-term growth of your investments? In this video, we'll break down what inflation is, how it can erode your wealth, how different investments respond to inflation, and strategies you can use to stay ahead. By the end, you'll have a clear picture of how to navigate inflation like a pro. Let's get started. This is Wealthlocity. Here you create, protect, and grow your wealth fast. What is inflation? Inflation is the rate at which the general price level of goods and services increases over time, leading to a decrease in the purchasing power of money. Essentially, the same dollar buys less as time goes on. For example, if a loaf of bread costs $2 today, and inflation is 3% annually, that same loaf will cost $2.06 next year. While this might not seem like much, over decades, these small increases add up significantly. Inflation is measured using metrics like the Consumer Price Index, or CPI, which tracks changes in the prices of everyday items such as food, housing, and transportation. Central banks, like the Federal Reserve, aim to maintain stable inflation, typically around 2% annually. Why is inflation a silent wealth killer? Inflation erodes the real value of money, which can be especially damaging if your investments or savings don't grow at a rate that exceeds inflation. For example, if you save $10,000 in a bank account earning 1% annual interest and inflation is 3%, your money loses purchasing power over time. After 10 years, that $10,000 will effectively be worth only about $8,530 in today's dollars. This is why understanding inflation is critical. It doesn't just affect the economy as a whole, it impacts your everyday financial decisions and long-term goals. How does inflation affect different types of investments? Not all investments respond to inflation in the same way. Let's look at how inflation impacts some of the most common asset classes. 1. Stocks. Stocks are often considered a good hedge against inflation. Companies can pass on rising costs to consumers by increasing prices, which can maintain or grow their profits. However, high inflation can also lead to higher interest rates, which may reduce corporate profits and hurt stock prices in the short term. 2. Bonds. Inflation erodes the purchasing power of fixed-income investments like bonds. If you hold a bond with a 2% annual return during a 3% inflation period, your real return is negative. Inflation-linked bonds, such as Treasury Inflation-Protected Securities or TIPS, can offer protection in such scenarios. 3. Real estate. Real estate often performs well during inflationary periods. Property values and rental income tend to rise with inflation, making real estate a strong inflation hedge. However, rising interest rates can increase borrowing costs, which may slow down real estate transactions. 4. Cash. Cash is the most vulnerable asset in an inflationary environment. Money sitting in a low-interest savings account loses value as inflation outpaces interest earnings. 5. Commodities. Commodities like gold, silver, and oil typically perform well during inflationary periods, as their prices often rise in response to increased demand or declining currency value. 6. Cryptocurrency. Some investors view cryptocurrencies like Bitcoin as a potential hedge against inflation due to their limited supply, though this relationship is still under study and carries significant risks. To understand inflation's impact on investments, let's explore some historical examples. During the 1970s, the U.S. faced high inflation paired with slow economic growth, leading to weak stock market performance. Commodities like gold and oil soared during this time, demonstrating their value as inflation hedges. In extreme cases like Zimbabwe's hyperinflation in the 2000s, money became virtually worthless. Real assets, such as land or foreign currency, retained their value when traditional investments failed. Post-2008 financial crisis. While fears of inflation were high due to stimulus measures, inflation remained low. Real estate and stocks, however, surged, highlighting the importance of diversifying your portfolio to mitigate various risks. How central banks combat inflation. Central banks, like the Federal Reserve, play a pivotal role in managing inflation by adjusting interest rates and using monetary policy. When inflation rises too quickly, central banks often increase interest rates to slow economic activity. Higher interest rates can hurt stocks, especially growth stocks, by increasing borrowing costs for companies. Bond prices fall as new bonds with higher yields become more attractive. Real estate markets may slow due to higher mortgage rates. Understanding central bank policies can help you anticipate inflationary trends and adjust your portfolio accordingly. Strategies to protect your portfolio from inflation. Here are some actionable strategies to ensure your investments stay ahead of inflation. 1. Diversify your investments. A diversified portfolio, including stocks, real estate, commodities, and inflation-protected bonds, can mitigate inflation's impact. 2. Invest in TIPS, Treasury inflation-protected securities. Adjust their principal value based on inflation, ensuring your investment keeps pace with rising prices. 3. Focus on dividend-paying stocks. Companies with a history of growing dividends often outperform during inflationary periods. These firms can pass increased costs to consumers, maintaining their profitability. 4. Add real estate. Real estate, especially rental properties, can generate income that rises with inflation, making it a reliable hedge. 5. Consider commodities and precious metals. Gold, silver, and oil often perform well during inflationary periods, providing a safe haven for your portfolio. 6. Review your bond portfolio. Consider reducing exposure to long-term bonds, which are more vulnerable to inflation, and focus on shorter-term bonds or inflation-linked securities. 7. Invest globally. Inflation rates vary by country. Diversifying your investments internationally can help offset inflationary pressures in your home market. Inflation's long-term impact on retirement. Inflation poses a significant risk to retirees who rely on fixed incomes. A $50,000 annual retirement income today may not be sufficient 20 years from now if inflation averages 3% per year. How to prepare? Include growth-oriented investments such as stocks in your retirement portfolio. Use inflation-adjusted financial planning tools to estimate future expenses. Consider annuities or pensions with inflation protection. And there you have it, a comprehensive guide to understanding the impact of inflation on your investments. Inflation can erode your wealth if you're not prepared, but with the right strategies and a proactive approach, you can protect and grow your portfolio. If you found this video helpful, please like, subscribe, and share it with others who want to make smarter financial decisions. Let me know in the comments. How are you adjusting your investments to handle inflation? Thanks for watching, and I'll see you in the next video with more money in your pocket.